So once you've issued shares and those shares are in the hands of the public, they are owners of your company. And like all owners, if the company is profitable, they're going to expect to receive a portion of that profitability. And for a corporation, you call that distribution of funds to your owners a dividend. Dividends are typically paid in the form of cash, though it is possible that in other instances you would issue things besides cash to your owners, like more shares of stock or other property. And by that I don't mean like you're sending them your furniture or your equipment. It's typically in the form of some type of debt, like a bond. But dividends, regardless of how you're paying them, is value that your business has obtained during the period, which is paid out to your shareholders. And for cash dividends, there is a term called legal capital. It is incredibly illegal to take out a loan to acquire funds, which you will then distribute to your shareholders. You can't borrow money to pay out dividends, because dividends are supposed to be a distribution of profitability, which means it is only legal to pay your shareholders cash dividends from your company's own internally generated profits, your retained earnings account. So dividends always have to come out of retained earnings. There are 3 dates that are key to the payment of any dividend, and they are the declaration date, the date of record, and the payment date. On the declaration date, the board of directors will announce, after they have approved, how much they're going to pay per share per dividend. So they will say, at some point in the near future, we are going to distribute, say, 50 cents per share dividend for our profitability for the period. And when they do so, they're going to set a cutoff point, and that is called the date of record. It essentially says, if you want to receive this distribution of income from our company, you have to own the share by a certain date in advance of the date that we actually pay it. And this is done so that investors don't go and buy shares of stock the day before a company pays dividends, receive the dividend, and then immediately turn around and sell those shares afterwards, because that constant buying and selling of stock would create a lot of fluctuation in stock price. Nobody wants that. So what the board of directors does is they announce a date of record, which is the last day that you have to acquire that stock if you want to receive payment in the future, because that actual payment happens on the payment date. So every time dividends are declared, the board of directors will say, this is the date of record, this is the cutoff point that you have to have, and payment is coming on this date in the future. Well, how do we account for this in journal entries? Well, if you are going to declare a dividend, you need to figure out what that dividend is going to cost you in the future. So on May 1st, Smart Touch Learning has declared a 5-cent per share cash dividend, and they have 22,700 outstanding shares of common stock. And outstanding is important because we just saw that companies will buy back their own shares and put them in treasury. Do you pay dividends to treasury stock? The answer is you don't, because it wouldn't make any sense to pay your company its own money. You're the ones that own the treasury shares. If you were distributing income to shares in treasury, you'd be taking money out of your company to put it right back into your company. That wouldn't make any sense. So dividend is always calculated based on outstanding shares, the number of shares the public actually owns. And in this case, since they're distributing 5 cents per share to 22,700 shares the public actually owns, that's going to cost them $1,135. That is the amount of money that they've generated from internal profits that they're going to distribute to their owners. In other words, that's the amount they're going to withdraw from their business to give to their owners. So we are going to denote that by debiting our cash dividends account, which is the withdrawal account for a corporation. And we're going to do so for that $1,135. This is only the date of declaration. We're not actually paying the dividends yet. We're just saying we're going to pay them in the future, which means we've committed to paying these dividends, but we haven't actually transferred any funds yet. We owe something. We owe our investors these dividends in the future. Since we owe something, we have to create a liability account, and that liability is going to be dividends payable -common. To denote the fact that we are now liable to pay a dividend in the future to our common shareholders, we credit that account for $1,135 as well. On the date of record, when it rolls around, the cutoff point that investors have to own stock by if they want to receive a dividend payment in the future, the company has no need to record a journal entry. Why? because nothing is materially affecting the financial position of the company. And they're not, actually sending out any payment yet. They're not increasing their liability. Nothing is changing within the company. So the date of record is purely for investors. It has nothing to do with the company's position. When the date of record rolls around, there's never a journal entry required. On the payment date, the actual date of payment, there definitely is a journal entry required, because now you are distributing that dividend which you declared previously. And when we did that, we put a liability on the books for $1,135, or actually paying that liability off now. So how do you record the entry to pay off a liability? Like you always do. You debit the liability for the amount that you are actually paying, and you credit cash for that same amount. So Smart Touch Learning will debit dividends payable common for $1,135. It will credit cash for $1,135 when they record the May 30th entry for the payment of this cash dividend. Cash dividends is a withdrawal account. Just like in financial accounting, your owner's withdrawals was your withdrawal account. And what did you have to do at the end of every period to that account? You had to close it, because withdrawal accounts, like revenues and expenses, are all temporary accounts. They only track how much of something occurred during a period. And when that period ends, well, then you have to reset it back to zero. So you need to close your cash dividends account at the end of every period. Since it has a normal debit balance, you will credit cash dividends for whatever the current balance of its T account is. Well, what account do you close it to? Legal Capital states that dividends have to be paid from your company's own internally generated profits, your retained earnings. So when you close your cash dividends account, you close it to retained earnings. And the entry to close cash dividends is always the same. It is the debit to retained earnings and a credit to cash dividends for the amount of dividends that you declared during the period. In this case, that would be $1,135. Paying dividends on common stock is a pretty straightforward thing. The amount per share of dividend will be set forth by your board of directors, and it will fluctuate as time goes on. Dividend payments go up and down. Well, for preferred stock, that's not the case, because there is a guarantee in preferred stock that dividends are always going to be equal to a certain percentage of your par value. So if Smart Touch, in this case, had preferred stock at 6%, well, that means that they're going to have to pay out 6% of the par value of that stock each year. And based upon that, assuming that this was $50 preferred stock, $50 par preferred stock, and they're paying out 6%, that would be $3 per share. And that's guaranteed. That will never go up and down. If you have $50 par preferred stock with a 6% dividend rate, it will pay out $3 per year regardless of how your company is operating. So to figure out what your preferred dividend is, you take your outstanding shares, the number of shares that you are paying the dividend on, multiply that by the par value of your preferred stock, and multiply that by the preferred dividend rate. Here we got Greg's Games. It has 1,000 shares outstanding at 6%. $50 par value, 1,000 times 50 times 6% is $3,000, which means for the year they are obligated to pay their preferred shareholders $3,000 in cash dividends. How much they have to actually pay depends on if there is an arrears clause in the preferred stock. Preferred stock comes in two forms, cumulative and non-cumulative. Cumulative means if they miss a dividend payment on preferred stock, if the company does, then they're obligated at that point to make all payments to their preferred shareholders before common shareholders can get anything. So back to Greg's Games here. Let's say they don't have the $3,000 which they're guaranteeing to their preferred shareholders to pay at the time. Well, they say sorry to them, and then the next time that dividends roll around, they would owe them another $3,000. Well, if they have the funds at that time, they would have to give those shareholders not only the $3,000 for the current period, but also the $3,000 from before. So they have to pay $6,000 in total to preferred shareholders before common shareholders can get anything. And that is how cumulative preferred stock works. There is non-cumulative preferred stock, which doesn't make that guarantee of back payments in case you miss a payment, but it's much less prominent in the market than cumulative is. Most preferred stock is cumulative nowadays. Lastly, we have stock dividends. And if your company pays a stock dividend, what it's doing is it's rewarding shareholders with additional shares of stock in lieu of transferring them cash. And companies will do this if they know they don't have the available cash to be able to pay those dividends, but they want to give shareholders something, because if you just skip out on a dividend payment, it has a very, very negative effect on the price of your stock. No one wants to be invested in a company where they're not paying out any portion of their profitability, because there's no profitability to be had. So in this case, what happens is instead of handing out cash, the board of directors says, we don't have cash right now and we're sorry, but we'll do something to make it worth your while. We're going to give you additional shares of our company. And when you record a stock dividend, it's usually based upon a percentage, which essentially says that we are going to distribute X% of our current shares which are outstanding to the public. So in this case, Greg's Games is going to have a 5% common stock dividend when they pay these stock dividends, or when they declare these stock dividends. And the market value going of their stock at the time is $50 per share, but par on their stock is $1 per share. Well, what do you do in this instance? Well, your dividends account is still a withdrawal account, but in this case it's not cash dividends, it's stock dividends. So you're going to start by debiting stock dividends, and you find the amount of that debit by taking the per share market value, multiplying it by the number of shares which you currently have outstanding, in this case 2 million, and multiplying that by the dividend rate. So if their shares are trading for $50, there's 2 million shares out in the market, and they're going to distribute shares equal to 5% of their current outstanding shares. Well, that means the market value of all of the shares they're going to distribute in this stock dividend is $5 million. You're going to next credit stock dividend distributable, which is a liability account, by taking the par value of those shares which you are going to distribute, multiplying it by the number of shares that you are distributing, which you can find by taking the number of shares currently outstanding and multiplying it by the dividend distribution rate. So $1 times 2 million times 0.05 is $100,000. And essentially what they're saying is the par value of these shares which we are issuing to the public in the form of a stock dividend in total is $100,000. And since your debits don't equal your credits, you're going to have to account somehow for a $4.9 million credit, and what that's going to go to is to your PIK common account.